Welcome to the Stock Market Palantir. Today, we are going to talk about CJET.
Right, and we're analyzing CJET Motor Company, which has, it's executed one of the most radical and frankly structurally questionable corporate pivots I've seen in a long time. This company has just completely abandoned its legacy as a struggling Chinese new energy vehicle manufacturer.
And it's become a speculative digital asset holding company.
Exactly. Anchored by this massive, almost unbelievable $1 billion acquisition of something called Edge AI tokens.
And that strategic shift is really where we find the central tension for today. The core question is this alignment with high-risk digital assets a necessary, even legitimate attempt to unlock, massive asymmetric shareholder value? Are they just embracing the AI and crypto themes to find a path to survival that the old business absolutely did not offer?
Or is it the opposite? Is this a textbook example of terminal financial engineering? A strategy that is just laser focused on maximum dilution of shareholders and an exit for insiders, all while using the market's excitement for AI and Web3 as, camouflage for some very severe ongoing corporate distress. And I'm going to argue that the structural pathology of this company overwhelmingly supports that second interpretation.
And I'll be arguing that for a company that was, let's be honest, facing imminent collapse in a capital-intensive, low-margin sector, this drastic pivot is really the only viable move they had. It transforms a liability, all that industrial infrastructure, into a speculative advantage. And it leverages the stock's very unique low-float, high-volatility structure to potentially generate exponential returns for new investors.
And my position is that the company's long history of destroying shareholder value, which is now capped by the just absurd financial mechanics of this Edge AI deal, makes the stated valuation completely meaningless. This isn't growth. This is an unsustainable survival strategy, and it's driven purely by the hype cycle.
Well, let's look at the baseline. Before this pivot, the company's market cap was what? Scraping along at roughly $1.74 million? That figure alone is the forensic evidence that the legacy NEV production plans, in Jilin or Yente, they were completely non-viable. They were just locked into an industrial sector that demands billions in capital. So the strategic shift to edge intelligence and DeFi, it's not a luxury. It was an agile, existential move to escape those constraints.
See, calling it agile is generous. I'd call it a flight from reality. The core issue here isn't the failure of the old business. We can agree on that. It's the financial fiction that's propping up the new one. You mentioned the Edge AI token acquisition, valued at $1 billion.
Right.
How? How can a company with a $1.74 million market cap credibly acquire $1 billion in assets? The financial math itself dictates they have to issue equity on a scale that, it results in virtually infinite dilution compared to where they started.
But that dilution is what fuels the pivot. Management is focused on the structure of the deal. They claim they got an exclusive 20% discount on that billion-dollar acquisition. They assert this generates $200 million in immediate, upfront, notional value for shareholders. Now, that massive number, however theoretical it might be, it instantly changes the balance sheet narrative. And the goal is clear: transition from industrial debt into intangible, high-growth assets by becoming a validator node on the Edge AI network, which promises recurring revenue.
I just reject the entire notion that a notional $200 million discount generates any real value when the delivery mechanism is so fundamentally pathological. Just look at the company's history. We aren't discussing standard dilution here. We are looking at the systematic destruction of shareholder equity, evidenced by a cumulative 1-for-3,000 reverse stock split.
Wow.
Executed over just 16 months.
But you're focusing exclusively on the pain inflicted on legacy holders, people who chose to stay in what was clearly a dying industrial stock.
I'm detailing the corporate pathology that defines this entity. If an investor owned 3,000 shares before this latest action, they now hold a single share. This isn't strategic restructuring, this is death spiral financing in practice. It's the systematic issuance of cheap equity just to stave off operational collapse, and it effectively liquidates the company share by share. This history is overwhelming evidence that the company is driven by short-term survival and capital extraction, not long-term value, and the going concern warning filed with the SEC just confirms this terminal strategy.
The very fact that they survived that period of distress by executing these necessary, albeit painful, capital adjustments, it proves the resilience of the listing mechanism. It bought them time to execute the pivot. And now, that same mechanism is fueling this crypto shift. If you're a new investor coming in after the split and after the Edge AI announcement, your focus is purely on the future growth narrative, not the historical baggage.
But the structural instability is still there. So let's address the core of the deal, the $1 billion Edge AI transaction. You admit it's opaque, but we have to interrogate the viability.
Agreed. Let's do that.
Okay. The counterparty, Edge AI Frontier Technology Limited, it lacks any kind of institutional-grade transparency. We see confusion in the corporate lineage, possible links to a dead-pooled UK entity, and their main digital presence relies on a .xyz top-level domain.
Mm-hmm.
And look, while that TLD is common in the Web3 space, it really strains credulity for a billion-dollar institutional transaction involving a public company. And furthermore, you said they plan to operate a validator node. How exactly does a former automotive company, one that was struggling just to finance NEV production, suddenly acquire the computational infrastructure, the security protocols, and the specialized engineering talent needed to support a billion-dollar enterprise-grade distributed network? The operational pivot is as fictional as the valuation.
That's a powerful point, but I think you're applying traditional industrial or, banking due diligence to an entity that's operating in a highly frontier market. The opacity of the counterparty, the unconventional domain, these are features, not bugs, of the high-risk Web3 ecosystem. It's a space where notional values are paramount, and frankly, early operational infrastructure is often outsourced or just minimal.
But value requires liquidity. It requires enforceability.
The acquisition's purpose isn't immediate, tangible operational cash flow from staking rewards today. Its function is twofold. First, its narrative alignment. It instantly positions CJET as a publicly traded crypto proxy. And second, it provides a speculative catalyst for liquidity. The true value isn't generated by the asset itself in the short term, but by the massive capital inflows that are generated by that $1 billion headline. That headline is the commodity they're selling to the market, and the 20% discount is the psychological hook. The tokens might be illiquid now, but the stock price volatility certainly is not.
And that focus on volatility over substance leads us straight to governance. You celebrate their leadership agility, but these appointments are, well, they're highly unorthodox. Miss Melissa Chen, the CEO, her primary background is as a journalist and an activist. Mr. Jason Miller, the COO, is mandated to spearhead the crypto treasury overhaul. These appointments signal a management team that is dedicated to narrative creation and market communication, not the rigorous operational or financial expertise you'd need to manage a billion-dollar asset fund.
I frame that as decisive, necessary adaptation. The old management failed. To execute a radical shift into digital assets, you need leaders who understand the new market, the speculative thesis, the power of communication, not just industrial logistics. Selecting a CEO who is skilled in public relations is a strategic move when the stock's survival depends entirely on maintaining a compelling story and attracting new, digitally savvy capital. They are intentionally changing the company's DNA.
But this change in organizational structure is complemented by a change in legal architecture that, to me, suggests regulatory evasion. The company is domiciled in the Cayman Islands. This isn't incidental. That jurisdiction offers extreme flexibility for complex financial re-engineering, including the rapid execution of those dilutive deals, and it provides significant regulatory arbitrage opportunities.
Flexibility is essential for speed in Web3.
It's a flexibility that fundamentally restricts minority shareholder rights compared to US-based firms. It makes it significantly easier to execute transactions like the massive equity issuances needed for the Edge AI deal without an immediate legal challenge. And, the delayed name change to Digital Currency X technology suggests they're operating in a regulatory loophole, benefiting from the NEE legacy name while transacting purely in digital assets. The whole structure is designed for opacity.
They're optimizing for capital formation in a global market that values speed over, domestic regulatory burdens. And while I'll concede the governance is atypical, Its primary function is to enable that asymmetrical return potential we started with.
Then let's shift to the market structure, because this is where the pathology really reveals itself. I argue the stock price is determined not by the crypto narrative or by fundamentals, but by structural manipulation and distortion.
And I'd argue those distortions are the very engines of the speculative thesis.
The forensic data is striking. 62.94% of short volume in CJET occurs in dark pools, or alternative trading systems. Now, for our audience, these are non-public exchanges that lack transparency. This practice impairs genuine price discovery, which is essential for a low-float stock like CJET. It's a mechanism that allows institutional players like UBS and Citadel, who recently liquidated almost all their positions, to exit large volumes of shares quietly without crashing the price on the lit exchanges.
But that structural selling is what creates the compression needed for the explosion.
It also generates structural settlement distress. The persistent appearance of this company on regulation SHO lists alongside frequent and substantial fails to deliver, or FTDs. It's all evidence of a fundamentally chaotic settlement environment. FTDs are essentially a failure to locate or deliver shares after a trade. This suggests a severe discrepancy between share supply and short demand, potentially linked to aggressive shorting or even, controlled synthetic creation of shares. The data points to controlled distribution, not organic growth.
I acknowledge the FTD data and the use of dark pools for institutional exit, but attributing that solely to controlled distribution overlooks the massive countervailing force, which is retail buying pressure. The settlement chaos you describe is a symptom of extreme volatility driven by a hyper-aggressive short-selling environment, which, in turn, creates the explosive potential that retail traders are actively looking for.
It's high-risk chaos, is what it is.
It is volatility leverage. You have a microcap stock with an incredibly tight float, only about 1.7 million shares, and a remarkably high short interest, sitting at around 21% of that float. So when a compelling narrative catalyst like the $1 billion Edge AI deal hits the tape, the short sellers who've been exiting in the dark, they're forced to cover in the light. That's what creates the short squeeze. The 45% jump the stock saw on the news demonstrates that the price action is totally divorced from fundamentals and is driven purely by the possibility of that squeeze being triggered.
So you're arguing that the entire investment thesis is predicated on the financial instability you just detailed?
I'm arguing that the investment thesis is predicated on leveraging that instability. New investors are buying the volatility. They're buying the narrative that this is now an AI and crypto proxy. Whether the validator node is even operational is secondary to the fact that the stock trades like a high-growth speculative play, with immense squeeze potential. For those who can tolerate the risk, the asymmetric reward is real, purely because of the market structure the short pressure has created.
That definition of market value is ephemeral. It's potentially terminal. It relies on a ceaseless influx of capital, buying the narrative faster than the company issues new dilutive equity just to survive.
It's the reality of the highly speculative microcap market.
So to summarize my view, we have looked at a company whose financial history is defined by an unparalleled 1 for 3,000 cumulative reverse split. It effectively erased the original shareholder base. The spectacular billion-dollar Edge AI headline, while it's an effective lure, it necessitates a degree of dilution that fundamentally destroys value. My forensic conclusion is that this company shows all the characteristics of a distressed equity surviving through manufactured volatility and a highly suspect government structure designed for capital extraction.
And I see CJET as the quintessential example of a microcap where the narrative, supported by high short interest and a low float, takes absolute precedence over traditional accounting. The strategic pivot, however unorthodox and high risk it is, was the only path to potential survival and, yes, massive asymmetric gain for those willing to embrace the volatility. They successfully transformed a distressed industrial shell into a powerful speculative crypto proxy.
And I believe the material proves that the financial structure, the Cayman domicile, and the history of terminal dilution, they all outweigh the speculative headlines. The market microstructure, especially the heavy use of dark pools for short volume, suggests controlled distribution. The institutions are getting out, and retail is providing the exit liquidity.
The complex dilemma for any market participant really lies in determining whether the momentum of this AI and crypto narrative can outpace the reality of capital erosion and the inherent going concern risk that defines CJI's operational state. I think the material offers a potent case study on the nature of value in these highly speculative markets, where the traditional rules, well, they just don't seem to apply anymore.
And the material also demonstrates that complexity often hides pathology, and that structural reality eventually demands a reckoning, regardless of the narrative.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.